What up, nerds? My name is Luke. I help people who are interested in cryptocurrencies get some returns on their savings through the power of DeFi. So today I'm going to talk about USD Plus. This is a protocol that's cross-chain, and yesterday there was a collapse in the value of the USD Plus coin on the Binance Smart Chain. So I'm going to talk about what it is, what happened, and I'm going to go into a bit of a in-depth deep dive into the value of USD and if I'm going to be investing in it. So USD is basically a rebasing coin that's backed by a portfolio of stablecoin firms, and the holders on the Binance Smart Chain lost 85% of their value in an instant. So this is a pretty big deal, given this is supposedly a stablecoin farm, a safe investment. It's a coin that tries to be basically stablecoins. It's aimed to be about one-to-one backed with USDC. So what is USD Plus? Well, the quote from the company itself is USD Plus is USDC that pays you yield daily via rebase. So effectively what it actually is, it's more like a managed fund that's on chain. So it's on Binance Smart Chain, Optimism, Polygon. It's invested in multiple stablecoin DeFi investments and aims to generate from 5 to 20% APR a year. The coin itself, USD Plus, is pegged 1-to-1 to USDC. So as the backing increases in value, the protocol rebases the USD Plus, which means it increases the amount of the tokens that all the holders have, so that it's always redeemable 1-to-1 to USDC. And as we'll see, actually, when the value dropped, they did a negative rebase, meaning it dropped by 85%. They reduced the supply in all the holders by 85%, and then again it was 1-to-1 to USD. So what exactly happened? Well, on the Binance Smart Chain, one of the investments was a LP pool on a decentralized exchange called Equinox DEX. And the management over there in Equinox DEX accidentally ran a function that they shouldn't have ran and locked up the entire position for 10 years. And at the time, that was a significant percentage of USD Plus's portfolio. So, 50% of the portfolio has been locked for over 10 years. Overnight Finance, that's the company that manages and develops USD Plus, valued the locked position at zero, and USD Plus holders lost 85% of their investment. In addition, Overnight Finance is also looking into options to kind of compensate their investors for this loss. Now I'll show you the chart of USD Plus on the Binance Smart Chain to give you an idea of what happened. So effectively, on the 2nd of November, a issue happened because of the management of Equinox DEX, where they locked the funds, and then once the news got out, once Overnight Finance realized, you had people rushing to try and redeem their tokens, and they were able to effectively redeem at some lot of a loss. Other people were able to sell their USD Plus into the USD Plus, BUSD pool and get some of their funds back, while a bunch of the other people who hadn't seen this, who hadn't realized, they were stuck holding USD Plus, and then as people redeemed, the actual value, which should have only been a 50% loss, went all the way down to a 85% loss. It should have been a 50% loss because the portfolio only had about 50% of its value in the DEX. So as you see here, you had this massive drop off over the space of a day, down 85%. And then Overnight Finance locked any redeems, prevent any further loss. And then they did a negative rebase, which means that they reduced the supply of all holders, and that brought the value back to peg. Now, it looks like it's recovered, so that means people have not lost money, but no, that's just the price people actually have in terms of value are down 85%. So is it reasonable to value the locked LP at zero? So this is the first little bit of analysis I'm going to do. Think about, well, what would you pay if someone was to say, all right, I'll lock some amount in an LP pool, some amount of stablecoins in an LP pool for 10 years. How much would you pay for that LP position? So first things first, I would say there is a time value of money, meaning that there is a opportunity cost to having your money locked. And in DeFi, I would say it's reasonable to say it's about 5%, meaning that if your money wasn't locked, you could have it in somewhere more liquid, getting a return of about 5%. So your opportunity cost is 5% a year. Therefore, a locked investment for the next 10 years would be valued presently at around 61 cents. Now, that's not including all the risks associated with having your money in DeFi and all these different pools and tokens. So the LP itself was made up of BUSD, USDC, and USDT. Now, in a vacuum, these are the most stable, most valuable stable coins out there. You know, they're backed by legitimate businesses. That's Binance, Circle, and Tether. However, it is 10 years. 10 years is a long time in crypto. Crypto hasn't even been around or at least DeFi and Ethereum haven't been around for 10 years. And these companies, Circle, Binance, they haven't been around for 10 years either. So the chances that any of the three go bust is significant. And in reality, if only one of them goes bust, then the entire pool will go to zero. So like if you gave a really rough estimate saying, I don't know, you have 50% chance of any one of them going bust. And then you also include the risk that the management of the DEX has some more issues, maybe more bugs, or they make some more mistakes. And then you have a pretty significant chance of losing the entire investment. So I would say there's not more than 10% chance that you'll get back these stablecoins. So in total, the locked LP value, the present value, I wouldn't say is any more than 6 cents. So I wouldn't pay anything more than 6 cents on a dollar. In fact, I would pay much less. So on the Binance Smart Chain, I think it's $400,000 locked up in this LP. So that's effectively at most maybe 24,000 that someone might pay for that position. Right, so is this the end? Is that the end of USD Plus? Had a big value wipe, and is it done? I would say no. This is not the death of USD Plus. USD Plus itself is, as I said, it's like a managed fund. So just with all funds, whenever you put your money into farming or DeFi or anything to do with yield or any investment, there is a risk. All these investments have risks of loss. And in fact, this is just one realization of that loss. Now, it's unfortunate it happened so quick, only, I don't know, maybe a month into the protocol, and it was so large, and the structure of the minting and redeeming is such that some people got less than the expected loss, which should have been about 50, and some people, realized a lot more than that. So there are many positions backing USD Plus that generate a yield. Each one has different risks, whether it's market risk, smart contract risk, or just like in this case, the management calling a function that they really shouldn't have called and just mismanaging and causing issues. So going forward, is USD Plus a worthwhile investment? And that's the question I'm going to look into now. That's the question I'm going to analyze. So first things first, we have to know what is the portfolio of USD Plus. What is actually backing it? What are the yields? What are the risks? And what are the different protocols that USD Plus is invested in? So we'll have a look at the Optimism chain. And this is USD Plus on Optimism. Currently, there's about $5.3 million invested into USD Plus. You can see the protocols here, and you can see the breakdowns of the different percentages. So we have Pika DAO, that's like a futures, like perpetual futures. You have Reaper. This is a strategy on Reaper, which is like a yield aggregator kind of strategy protocol. You have Beethoven X, that's like Balancer, that's a decentralized exchange. Rubicon is another derivatives trading platform. And Aave at the end, which is effectively for USD plus in our portfolio is effectively cash, and it's just USD put lent on Aave. So each of these have their own expected returns. Right, each one have some returns that they're generating. For the case of Pika and Rubicon, you have incentives and fees. Similarly, Reaper uses a specific strategy of lending and looped lending. So you have mostly the returns coming from incentives. Beethoven, mostly returns coming from fees, and you have some incentives as well. Similarly, Aave, you have it from interest. So let's look back at the portfolio and let's look at the breakdown of the risk and return. So for each protocol here, I've shown what the weighting is, what allocation to the portfolio is to that specific protocol, what the expected return is, what the APR is, and a kind of upper bound of the smart contract risk. So that's basically the probability that there's going to be some sort of issue, whether it's bugs, hacks, whatever, related to the smart contract, related to being on the protocol in general. And I've got these figures mostly from InsureDAO. And InsureDAO is a decentralized insurance protocol that gives you smart contract protection, basically, and you charge for it. So the upper bound is what they're charging. I'll show you InsureDAO. As you can see, this is for Optimism. So a bunch of the major protocols, you have Beefy, Taro, these are Yield. These two are dexes, you have Lyra, options, synthetics, etc. So each one, they have a specific cost per year. And that's a pretty good upper bound. You know, if you're not sure what the smart contract risk is on a platform, if you're not sure how to factor it in, looking for an insurance protocol and then using their cost as an estimate is a pretty good place to start. All right, so just looking at each one of these individually, so not even taking into account that they're all mixed together in a portfolio, individually looking at the returns and the risks, you can quickly see that these are all actually negative expected value. That means, you know, let's take PikaDAO, for example. You would expect 85% of the time, no issue, and you get a nice 11% return. However, 15% of the time, there'll be some sort of smart contract risk, and you might end up with zero. So the expected value of just that position in isolation is negative money. If you put your money out there, you're going to lose it, or at least you're expected to lose it. Similarly with Reaper, actually the risk is really high because you don't have just one smart contract risk, you have two, and they are multiplicative. Similarly, you have Beethoven, again, risk is higher than return. Rubicon, risk is higher than return. And even Aave. Aave's current return is pitiful. It's basically zero. But there is a risk that there's some sort of smart contract issue. Now, actually, I would say Aave is probably one of the most safe. And if you're comparing the risk of protocols, I would usually compare Aave versus some other protocol to give you an idea of how much return you're getting relative to the risk you're taking. But the figure here I took, 2.6, this is from Nexus Mutual. Again, another decentralized insurance protocol. Right, so what if we take some, a less conservative estimation of risk? These are insurance protocols. They're trying to make some money from the premium. So what if we say that the risk is actually half the quoted cost of the insurance? Is it then profitable? Is USD plus the portfolio of all our assets, is it positive expected value? And then should we invest in it? So I'll quickly go through. Now this is going to get quite math heavy. It's going to get quite number heavy, but I did a little spreadsheet to kind of go through. You don't have to understand all of it, but hopefully I'll give you an image of what kind of analysis I do to look at whether or not something is worthwhile investing. So first things first, we just break down, again, same numbers as we did in here. We just look at the portfolio allocation. We look at our expected APR if nothing goes wrong. We look at the risk of complete loss. And then by doing that, we can create a expected value of the returns. So as you can see here, the expected value of each one individually, and then you sum them up all together to get the expected value of the entire portfolio, which is about 1.35%. Now this is very different from the advertised expected value. Now, if you didn't take into account the risk of loss and you only looked at the APRs, you would actually get a estimate of about 13.5% APR using USD plus. But that's, of course, best case scenario. There is a chance that you're going to lose everything or some portion of it. And that's why the isolated EV actually goes down a bit. So that's in isolation, of course. Now, this is a portfolio, so you can't just look at the EV of each of the positions. You have to look at the EV of the entire portfolio. So how do we do that? Well, we have to consider all the different outcomes that can happen. And I'm going to simplify this a tiny bit to start. We're going to look at just assuming that there's only 4 positions. We're not going to include AVE. We're not going to look at the cash for now. So if you just have 4 positions, right, and you consider that there's only 2 outcomes for each of the positions. Outcome 1, nothing happens, you get your return. Outcome 2, there's some sort of, the risk is realized and you lose everything. Okay, so we have to do we have to look at the joint probabilities, all the different combinations of the outcomes. So here it's just simply I've written Y is just, if everything goes right and each of the 4 positive outcomes happen, meaning none of the protocols the risk will be realized and we'll just get our return. So as you see, the joint probability, meaning the probability that everything goes right, is only about 67%. The value if everything goes right is 1.135. And you can do that for each of the different outcomes. So you have an outcome where everything goes right, you have an outcome where everything goes wrong, really low probabilities, and then everything in between. So you have to consider each of these different things to look at the entire expected value of the position. So when we're looking at the expected value, we have, now this is just the arithmetic, meaning we just add it all together. We get about 1.013. So again, pretty low, similar to what we got here. It's the exact same as what we got here. However, we're not interested in the arithmetic expected value because this is a portfolio, because we're just putting a bet on and we're going to let it compound over time. That means we're not averaging over many different bets, which is arithmetic. Like if we had 100 or thousands of individual different USD pluses, then we could say, okay, that's our expected value. That's what it's going to average to. However, we're actually taking a time average, meaning that it goes maybe 1 year you get 10%, maybe 1 year you get minus 5%, right? How you do that is the geometric average, and it's basically just multiplying it together and then kind of doing like a square root across all the different outcomes. And if you do that, if you just take this portfolio and you look at the geometric expected value, it's actually 0.92, which means we're actually losing 2% a year just holding this portfolio. So that's not great. That's pretty bad. And the reason for this, the reason it's so different than the expected, is because we have these pretty big chances of large losses. Like, let's look at the value of one of these. See, here, 10% of the time, we actually lose 40% of the entire value of the portfolio. Now, that's pretty significant, given that the best case scenarios is only 13% up. And the only other outcome is about 5% of the time we get about 2% up. All the others are losses, and they're quite significant losses, as you can see. There are 50% losses, 60% losses, 30% losses. So if you factor all these in, you actually have a pretty bad portfolio altogether. So next, maybe let's make it a bit more realistic. Let's try replicating the portfolio of USD Plus. So this means just taking their allocations, taking their cash, and then just saying, okay, if we did this ourselves, not including USD Plus, because obviously if you invest in USD Plus, you also take protocol risks. You also take this risk given the minting and redeeming process. So just simply replicating the portfolio, taking the exact same positions and just doing it ourselves, which you can easily do as I showed you here. You could just click each one of these, see what they have, where are they doing it, and then just put that into your own portfolio. You really don't need USD Plus. There's no extra magic they're doing. They're just putting your money into these. So if we do this and we include cash, again, we look down and it's 0.984. This is the geometric expected value. So again, it's still negative expected value. However, it's a little better. So including cash, we actually improve our portfolio a little bit. So, I mean, the first question, most obvious question is, I mean, why would we hold this? Why would we ever hold USD Plus as opposed to just replicate the portfolio ourselves? Well, the reason you would do it is because it turns a full portfolio. It opens up capital efficiency, basically. It turns a portfolio into something that can be traded, something that can be used as collateral, something that can be used in an LP position. So that's the major benefit. So the big question right then is, okay, even if it's, the same value as holding USDC, or if it's negative, is there a value in having it just so we can use it for, say, lending or LP providing? So just looking at the LP, I'll go back to this. So first, just to summarize the analysis of the USD Plus value, the replicating portfolio is negative value. The geometric expected value is like 1.5% negative. So including protocol risks, this would be very negative, right? If we include the risks associated with being on the USD Plus protocol, the expected value is pretty poor, and most people shouldn't do it if you're just going to hold it. So that's the first thing we can see. And then the question, right, should we LP or not? So I found a pretty good LP on Velodrome. This is a decentralized exchange on the Optimism chain. So looking again at the risks associated with LPing, we have to now include a couple more risks. So the first one obviously is the risk of actually creating the LP and hosting it on the website to try and get the yield. And according to InsureDAO, that's about 5%. So there's about 5% chance that Velodrome, some issue is going to happen, you're going to lose your entire investment. Similarly, there is another asset that you're LPing it to. This is LUSD. Now LUSD, just like USD Plus, is trying to be pegged to the US dollar. So there's not much market risk. There's not much impermanent loss risk just from variance. However, there is smart contract risk because it's a over collateralized stablecoin. So it's one of the safer types of stablecoins. However, there is a chance that some smart contract hack, bug, etc., some sort of issue will happen and you'll lose your entire investment. Nexus Mutual again rates this at about 2.6%. And if we include another risk of USD Plus, just holding USD Plus is about 5%, again, smart contract risk and some of the other risks. Now we can properly estimate what the LP position is. So first we just assume that the actual value, the expected value of USD Plus is about 98.5 cents. The LP APR is around 14%, and the combined risk of holding the LP position is 12.3%. So if we do the math, we go in a spreadsheet, as you can see here, have some math up there, and it basically shows that the LP expected value is 99 cents. So it's less than USDC. However, it's more than just holding USD Plus on its own. Now, if you wanted to compare, okay, is this a good LP compared to some of the other stable LPs on Velodrome? So how do you do that? Well, you can remove the Velodrome risk, which is the 5% risk. And then if you don't include the 5% risk, the actual expected value of the LP has gone up to 1.043. So that's about 4.3 APR. And with this, you can then say, right, if I'm going to, should I, a different stablecoin like USDC and, I don't know, USDT, right? If that's a stable pair and the return on that is only 1% on Velodrome, if you have that, should you change? Well, probably. So the expected value, it says it's higher. So if you're already experiencing Velodrome risk and you're just comparing like for like, then this one is actually about 4%. So it's not bad. It's not amazing, but it's not bad. In totality, it's bad when considering Velodrome, but on its own, it's not terrible. So finally, one extra thing you can consider is, as we noticed here, that if we increase the cash allocation, the expected value actually increased. So this leads me to believe, this is one of the things you notice when you start looking at the geometric expected value of positions, or you start thinking about portfolios, combined portfolios, is that the allocation size, the portfolio weights, the weightings of your different investments in your portfolio actually do matter, right? The bet sizing really, really does matter. So let's ask a question and say, right, how much cash should we hold, relative to our USD plus investment to try and realize a positive expected value? As we know, it should have a positive expected value, but the reason it doesn't is because we're experiencing these large losses. So maybe if we have a smaller portion of our portfolio in USD plus and the rest of it in cash, we can maybe realize a positive expected. So I did that. I looked at different percentages cash, anywhere from 5%, 10%, 15%, etc., all the way up to the entire portfolio in cash. And if you see here, these in bold is the expected values. And as you increase your cash, the expected value actually increases. So let's see where it becomes non-negative. Boom. So the first non-negative value is at 50%. So at 50% cash, 50% USD plus, now you have a non-negative value. Now it's not positive. It's not exceedingly positive, but it's not negative. If you keep going up, where does it maximize? You can see here it's almost 0.2%, and then it kind of flattens out. So the optimal seems to be at 75%. Now optimal is, it's not the most optimal. It's only about 0.2%, 0.2% better than just holding USDC or some other dollar stablecoin. All right, so all in all, am I investing? That's the question. Now, I am actually holding a small amount of USD Plus and LUSD on Velodrome, on Optimism. And the reason for that is because I'm betting that the yield will stay roughly stable and that the protocol risks will decrease over time. Now, right now, the risks are pretty high, and that's just because protocols in general have higher risks when they're new, when they're untested. The longer that they're out there, the more battle tested that they're out there, the longer the time that hackers and issues and things can happen, the more confident you become that the protocol will last longer. In fact, there's a kind of name for this. It's called the Lindy effect, and maybe I'll do a video on that. It's pretty interesting. It's a good way of estimating how long you think something's going to survive, given how long it has already survived. So this is my bet. I'm betting on it a little bit. However, I am going to reduce my position significantly. Due to this analysis, it shows me that USD Plus seems to be pretty negative. I believe that I could probably replicate the portfolio better. They have way too much weighting on Reaper, one of the highest risks. So I just believe the construction and portfolio is not great. It doesn't have enough cash. It's not safe enough, and if you're going to go for high returns, there is better returns out there that I'm currently generating. So should you invest? That's up to you. You have to do your own research. This is just kind of guidepost of, how I sometimes do my analysis, what kind of things I think about, how I do some basic number crunching to kind of see whether or not something's profitable. But in the end, you have to assess it yourself. You have to think about what returns you think are reasonable, what risks you think are reasonable, and you have to determine how you factor these things in and how you construct your portfolio. You don't have to do it the same way as me. A lot of people don't. Most people probably don't. And in fact, I actually don't usually do it on Excel. I was just doing this to kind of show you that it can be done, and kind of calculations and things. I don't know, I'll show you some of these calculations. They're usually just basic stuff. I usually would do a simulation on Python. So do your own research. If you want to invest, you should make sure that you're confident in and you expect the risks. If something happens like what just happened in Binance Smart Chain, where you just lose 85%, you have to understand that was a possibility. There was a possibility you could lose that much, and if you didn't realize that could happen, then you probably shouldn't have invested in the first place. So that's it for today. That was a bit more in depth, a bit longer, bit more mathy. I tried not to go into math too much, but just give you an idea of how to do some DeFi investments, more the sophisticated analytical approach. So if you found some value, if you liked what you saw today, please like, subscribe, and stay tuned for some more content coming in the future.